The theory that I've studied for a good portion of my life, my adult life, was an idea written by William McCarthy in 1982 in the Accounting Review. The article was entitled Resources, Events, and Agent, and what Dr. McCarthy posited at that time was, in the days of a shared database, why do we have to have a financial system at all? If we have the database for our company capture all of the transactions, what he called basically business events, if the database captures these business events, why is it not possible then, when we need to make a financial summary of some sort, a balance sheet, an income statement, cash flow statement, any other kind of financial analysis, why can't we go gather up the transactions as of a point in time from the database and create the financial view that we want? The benefits of doing that would be that the financial view doesn't preclude other kinds of views of the data, that the other ways of seeing the data aren't destroyed by only recording the financial view. We could just record the business events, and we could then have other perspectives that would reconcile to the financial view, but that might be different than the financial view. So you might have a different way of recording revenue. Rather than doing a percentage of completion, you might be able to present a view that was actual completion of projects. Those would be things that are different ways of accounting for things, but companies usually have to choose one way, and the accounting system might be set up to only record the percentage of completion, and the actual completion process may not be visible. Another one is a very simple inventory concept of FIFO, first in, first out, versus LIFO, last in, first out. The accounting system is typically set up and to record one of those approaches up front, but the other approach may be valid for certain kinds of analysis, other kinds of analysis. And so if we gathered up the business events at the moment we wanted to produce the report, we could choose whether I wanted to see a LIFO view or a FIFO view of things. These kinds of decisions are often made within the accounting system. The chart of account is determined up front as to what will be measured and what's available to us. And those are the only things, if the data is recorded with those policies in mind, then that's the only thing the data will be able to tell us, is the policies we decided to record. But there's many different kinds of ways of viewing the data, that if we don't superimpose those policies on the event capture process, then we can see these other views. So what's resources, events, and agents? Resource, events, and agents are his idea, Dr. McCarthy's ideas, of the primary things that we need to capture around business events. Resources are things that the firm has, that they can be material goods, they can be financial goods, they can be factories, they can be other kinds of things. Every transaction that there is includes a resource of some sort. If you're selling a good to a customer, the thing that gets transferred to the customer is the resource. If you're purchasing materials, raw materials for the organization, the thing you purchase is the resource. So you want to capture on the transaction, you want to capture those resources. You want to say what the event is involved, and capture the attributes around the time, date, even location. Sometimes it's called resource, events, and agents, and location as well, because those are other things that you want to know about these, and they're used in a lot of different reports. And then the agent is usually, there's two agents involved, that there's an internal agent, an employee of the company in some way, and an external agent, either a vendor or a customer, taxing authority, other people that are involved, and those are the agents. So on our business events, we should be capturing those types of things and making sure that we know those kinds of things and do that very broadly, so that the people that are interested in the business events for any purpose, not just accounting, might be able to see what the attributes were on those events. If you were able to capture that sort of data on the business events, and then to capture and keep that raw detail, it is theoretically possible that if you kept the detail long enough, you could produce any financial summary that you wanted as of any point in time. The transactions, where we keep all of those attributes, the transactions are the most flexible for any kind of analytical process that we might want.